Spring is finally here with us, a perfect time for everyone to look for their dream home. It has been a trend in the past couple of years until today when everything has gone into shambles. We all thought things would take a better turn this time, but just as prices were starting to come down, things went up ablaze again. And this time the scorching heat of the housing market seems to be getting a lot hotter. Right now we are witnessing the anger of many buyers and the continuous enriching of the sellers. Bidding wars, packed open houses and absurd seller demands are once again a common story. Buyers are struggling to navigate this absurd situation. The crush that was on the horizon, the one everyone saw coming, is now at a stone's throw distance away, as buyers are ready to make the single biggest purchase of their lives. The story about DR Horton is once again hitting the headlines of the media. And now everyone is closely trying to understand why they are so bullish when a big crash is coming. This single company is the biggest house builder in the United States, and it's publicly traded, which means every quarter we receive insights that give us valuable information regarding the pulse of the market. DR Horton reported a massive 35% crash in income year over year, and they reported an insane 44% drop in their sales order backlog. Signals that this housing downturn is still getting worse, and it's hitting the builders' profits. Now here comes the craziest fun fact of all. The stock market and the housing market bulls actually love this earnings report. DR Horton's stock price right now is trading at the highest level of all time, with all mainstream financial outlets saying that they smashed earnings. This is a sign of an encouraging housing market, which is quite ironic for a company that reports a 35% decline in earnings and 45% declines in their future earnings through a logbook. At this point, you should not be the one still expecting the stock price to go down. Actually, you need to be doing the opposite. Why? Because there's a certain mania right now still in the stock market and housing market, where people who are bullish are doing anything they can to latch onto to justify their bullishness, thereby forgetting how their downturn is going to look like. DR Horton is a company that is currently trading at 5 times its order backlog value, so its current market cap is $37 billion, and having a backlog of $7.4 billion in the second quarter of 2023. On average, over the last 20 years, DR Horton has traded a 2.7 multiple to its order backlog. Now it's trading a 5.1 multiple. What this means is that the market is valuing DR Horton stock as if it's going to grow its current order book value significantly, which implies that there's going to be a massive housing market recovery. The stock market seems to think that we're going to see a return to 2022 and 2021 house sales, and that's the only way DR Horton's stock price makes any sense right now. If we don't see that return to 2020 or 2021 home sales, then we should all be ready to see a big crash in DR Horton's stock price. Overall, this DR Horton is not the only stock where the earnings are going down, but the stock price is still going up. And what really concerns us about this is how bad the fundamental data on the housing market looks like. For instance, mortgage applications to buy a house, the best real-time indicator of housing demand, is still down 36% year over year, with an index level of 162, basically the lowest level in the last 20 to 30 years. So there is no recovery in regular home buyer mortgage applications to buy a house. However, there's a perception of a housing market recovery building, because there's still a big shortage of new listings in low inventory on the market. Right now, many of us are experiencing bidding wars. You might even be asking yourself, how is it that there's a housing crash occurring, but I'm experiencing a bidding war? It's because of the supply side. Sellers are not listing homes. It is not because of the demand side, as there are no fundamental demand statistics for home buyers in America, which is showing recovery mortgage applicators are still at a 20 to 30% year loss. Meanwhile, existing home sales fell by 2.4% in March and are still near the lowest level in 30 years, and so there is no recovery occurring in the housing market. To see a recovery in the housing market, we need to see both mortgage applications and home sales go up significantly. We also need to see home buyer sentiments improve. But none of these things have happened yet, and the only thing we've seen is a shortage of new listings and home builders like DR Horton having earnings reports which are bad that people interpret as being good. Now, let's be honest and fair here. DR Horton, in the second quarter on sales, then people thought their revenues stayed stable year over at around $8 billion. But the problem came in not with the revenues, but the cost of sales. DR Horton's cost of sales increased by over $500 million, which directly led to a $500 million reduction in net income. And so, this brings us to the question, why did DR Horton's revenues stay at the same, but the cost of sales went up? Well, this is simple. DR Horton is offering homebuyers below-market mortgage rates to purchase homes. If you visit their website, you will see they have special interest rates. For example, you will get a 5.25% fixed-rate FHA mortgage with only a 3.5% down payment required, or you could get a 5.5% fixed-rate conventional mortgage with only a 5% down payment required. DR Horton is offering these rates of 5.25% and 5.5% when the prevailing 30-year mortgage rate is around 6.6%. So no wonder DR Horton had a short-term uptick in sales. They are allowing home buyers to buy below-market mortgage rates, and they're subsidizing that by providing mortgage rate buy-downs, which cost probably anywhere from $10,000 to $12,000 per loan. Actually, that's why DR Horton's cost of sales went up, because they're paying for these mortgage rates buy-downs instead of lowering the price. They're paying for people to have a lower mortgage rate, and that's creating the false perception of some type of recovery in DR Horton and other home builder sales. This is why when you look at new sales for builders, you will realize that they have gone up over the last couple of months, but are still at lower levels historically. So in this case, the bet that the builders and other people in the housing market are making right now is that they can keep the transaction volume decent by buying down the rates until the Fed pivots, and then mortgage rates go down. That's basically what everyone in the housing market is banking on. However, they haven't. They're back up to 6.6 to 6.7%. So how long would this last? Additionally, we have to appreciate the fact that there is also a big variation in terms of where the builders are having more or less success. According to the website reports, Zonda, net sales were down 51% in San Francisco, 46% Salt Lake, 41% in Sacramento, 39% in Austin, and 35% in Seattle, year over year. So we haven't seen any recovery at all for builders and these markets. Mountain West and areas of America, however, there is some slight recovery in Charlotte, Baltimore, and Raleigh, and maybe Dallas, Tampa, and Philadelphia. So this alone fits with a broader trend that we've been seeing in the housing market, where the Mountain West and the Pacific Coast of America and parts of Texas are struggling, whereas the Southeast and Northeast are still holding strong. This therefore means that there needs to be a substantial improvement in the leading indicators of home buying demand before anyone can say that there's a recovery in the housing markets. Currently, all the headline economic indicators are saying that the recession is here and it's going to get worse. What we don't know for now is what these builders are going to do when the cost of living doubles in the foreclosure rates in their community surge. A little known fact about DR Horton that we would want to share with you is that from their earnings supplements, the average down payment for a DR Horton home purchase and the mortgage is only 12%. That's because they have a very high share of FHA and VA loans, comprising their demand. 46% of DR Horton's home purchases are FHA and VA loans for people who have very low or no down payment, basically 3 to 5%. So as a foreclosure wave rips through America over the next 1 or 2 years, a lot of those foreclosures are going to be in DR Horton's communities, which is going to push sales of DR Horton built homes down, and so is the crash. Tell us your thoughts. Do you think DR Horton and its fellows should increase their prices or drop them to help the housing market avoid the crash? Please don't forget to share with us your suggestions in the comment box below. This brings us to the end of our video today. We hope you guys found this video interesting and especially informative. If you loved watching, please don't forget to send us those thumbs up. Also, if you are still new to this channel, do not forget to hit that subscribe button and the notification bell so you can always get notifications about our new uploads about the economy. Thanks for watching, and let's meet in our next video.